Lifestyle creep. Lifestyle creep is the phenomenon where your expenses rise at the exact same pace as your income. You earn a raise, yet you find yourself struggling to make ends meet by the end of the month, just like before. It happens subtly, through promotions, bonuses, or switching to a higher-paying role. As your salary climbs, your standard of living invisibly expands. Initially, it feels earned. You've worked hard, so you feel entitled to a nicer apartment, faster data, or more frequent dinners out. These upgrades seem logical, a sign that you're finally making it. Your mind frames this as progress. However, once that extra money hits your bank account, it disappears into higher rent, a more expensive car lease, and forgotten subscriptions. None of it feels like waste. It feels like the new normal. But the reality is that your lifestyle has swallowed your raise. You aren't building wealth or investing more, you're simply spending more to maintain the same feeling. The margin between what you earn and what you keep never grows. The trap isn't the money itself. It's the false belief that a higher income automatically equals more freedom. Real freedom is found in the gap between your earnings and your spending. Lifestyle creep eliminates that gap, leaving you broke at a much higher salary. The Car Payment Treadmill. The car payment treadmill is a cycle where you constantly trade in vehicles to chase a lower monthly bill, but you never actually achieve ownership. You are perpetually in debt, always owing the bank, and stuck in a loop of financing. It usually begins at the dealership. Your current vehicle is fine, but you're tempted by a newer model with better tech or safety features. The salesperson offers to lower your monthly payment, which sounds like a win. In reality, your old debt is rolled into the new loan. You're paying for a car you no longer drive, and your total debt has actually increased. The payment only looks smaller because the loan has been stretched from 5 years to 7. You're paying less per month, but paying significantly more in total interest over a longer period. A few years later, you repeat the process. Each time, you reset the clock and end up upside down, owing more than the car is worth. You're chasing a monthly number instead of equity. Meanwhile, the person who bought a car and kept it has been driving for free for years. You think you're moving up, but you're essentially just renting a depreciating asset under terrible terms.
The minimum payment illusion. The minimum payment illusion is a trap where credit card companies allow you to pay tiny monthly amounts while compound interest quietly explodes your debt. It gives you the false sense that you're managing your finances, when in reality, you're just feeding the bank. When your statement arrives showing a $3,000 balance, the $60 minimum payment feels affordable and safe. You pay it and move on. However, behind the scenes, almost all of that $60 goes toward interest. Perhaps only $10 actually reduces your debt. The following month, interest is calculated on the nearly full balance again. At this pace, a small debt can take over a decade to clear, and you'll end up paying back double what you originally spent. The trap works because the small payment feels harmless. Your brain stops doing the math because the immediate cost is low. Credit card companies don't design these payments to help you. They design them to keep you as a permanent source of revenue. Minimum doesn't mean enough. It means endless.
House poor. Being house poor occurs when you purchase the most expensive home the bank will allow, leaving you with no money for anything else. You might own the deed, but the mortgage owns your life. When a lender tells you that you qualify for $400,000, you treat it as a green light. You buy at the top of your limit, assuming you'll figure out the rest later. Then, the true cost of homeownership sets in. The mortgage consumes half your paycheck. Then come the property taxes, insurance, and the inevitable repairs. The broken AC, the leaky roof, the yard maintenance. These costs weren't in the bank's simple calculation. Suddenly, vacations are canceled, and savings accounts dry up. A single broken appliance becomes a financial catastrophe because there is zero breathing room in your budget. You're working long hours just to keep the lights on in a house that was supposed to be a symbol of success. The bank approved you based on the maximum they could extract from you, not what was best for your life. You wanted a home, but you ended up in a beautiful financial cage. The whole life insurance scam. Whole life insurance is often pitched as a forced savings plan that combines protection with an investment, but it mostly serves to enrich the brokers. The sales pitch is tempting: lifelong coverage and a cash value you can borrow against. You feel like you're making a sophisticated financial move. However, the reality is bleak. A massive portion of your early premiums goes toward the agent's commission and fees. What remains grows at a dismal rate, often just 2 or 3%. In contrast, you could have purchased a cheap term policy and invested the difference in an index fund, likely resulting in hundreds of thousands of dollars more over time. The math simply doesn't favor the consumer. Worse yet, if you want to use your cash value, the company makes you pay interest to borrow your own money. And if you pass away, they keep the savings and only pay the death benefit. It's not a wealth-building tool. It's a wealth transfer from you to the insurance company.
Paying for convenience. Convenience spending is the death by 1,000 cuts. Small, daily shortcuts that drain thousands from your wealth every year. Delivery fees, premium tiers, and instant services feel negligible individually, but they are devastating in total. It starts with a food delivery because you're tired. Between the service fee and the tip, you've spent $15 just to avoid cooking. When this becomes a habit, you're losing thousands annually. Then there are the ghost subscriptions, streaming apps you don't watch, cloud storage for junk files, and gym memberships you don't use. Each is only $10, but a dozen of them add up to a significant monthly drain. We pay for express shipping, pre-cut groceries, and premium parking. Every choice trades your future wealth for a fleeting moment of comfort. By the end of the year, these invisible costs can easily total $5,000, money that could have been used to kill debt or fund a dream. Convenience isn't the problem, but making it your default setting will bleed you dry.
Keeping up appearances. Keeping up appearances is the act of financing a fake lifestyle to impress people who aren't even paying attention. You buy clothes you don't need, go to dinners you can't afford, and post expensive vacations online, all fueled by debt. It's driven by comparison. You see a colleague's new watch or a friend's travel photos and suddenly feel behind. To prove your success, you reach for the credit card. You're buying status for an audience that is actually too busy worrying about their own image to care about yours. The truth is that the people you are trying to impress are often just as broke. Their luxury is also funded by high-interest loans. You're paying interest on a life you're faking, while the debt prevents you from ever achieving real financial security. You're trading your future for the approval of strangers. The emergency-free delusion. This is the dangerous assumption that life will always go perfectly. People live paycheck to paycheck because they assume their car won't break, their health won't fail, and their appliances won't die. Every cent is spent before it arrives, leaving no room for reality. When the inevitable happens, a dental emergency or a car repair, it becomes a crisis. Because there's no cash buffer, you turn to high-interest credit cards, turning a temporary problem into a long-term debt cycle. Emergencies aren't if events, they are when events. Living without an emergency fund isn't being an optimist, it's being unprepared. You are always just one bad break away from total financial collapse. Retail therapy addiction. Retail therapy is the habit of using consumption to manage your emotions. You feel stressed or unhappy, so you buy something to get a temporary dopamine hit. It works for an hour, but the resulting debt and guilt eventually make you feel worse, leading you to buy more to escape that new stress. It's a self-destructive loop. Retailers capitalize on this by creating a sense of urgency through limited-time sales. You think you're treating yourself, but you're actually medicating your feelings with merchandise. The high fades, but the bill and the interest stays. You are paying a premium for a temporary distraction from problems that spending can never solve. The retirement delay is the "I'll start next year" trap. You tell yourself you'll save once you earn more or once your bills are lower. But by waiting, you lose the most valuable asset in finance: time. Compound interest isn't about how much you put in, it's about how long it stays there. A small amount invested in your 20s is worth far more than a large amount invested in your 40s. While you're waiting for the right time, you are burning the years that would have done the heavy lifting for you. There is no perfect time to start. The math is clear. Starting small today is infinitely better than starting big a decade from now. Brand loyalty tax. The brand loyalty tax is the extra money you pay for a label rather than the product itself. In almost every category, medicine, clothing, groceries, the generic version is chemically or functionally identical. You aren't paying for better ingredients,
you're paying for the company's marketing budget. Corporations spend billions to make you feel like their logo says something about your status or taste. When you buy the name brand, you are funding the very advertisements used to manipulate you. True quality matters, but most of the time, you're just paying a premium for a story. Breaking this loyalty can save you tens of thousands of dollars over your lifetime, with zero change in your quality of life.
The side hustle trap. The side hustle trap is when you work a second job to support an expensive lifestyle instead of simply fixing your spending. You trade your limited time and energy to treat the symptom of being broke while ignoring the disease of overspending. It starts when the budget is tight, so you drive for a rideshare or freelance at night. The extra money feels like a relief, but it often just fuels more spending. You're working 60 hours a week, so you feel you deserve more luxuries, which then require you to keep working the side job. You're on a treadmill. Cutting $500 in expenses is a permanent win that requires no extra labor. Earning an extra $500 requires constant, exhausting effort. Side hustles are great for building wealth, but using them to mask bad habits is a recipe for burnout and permanent debt.